Last week, markets were all over the place, and honestly, that shouldn't come as any surprise. October is historically the most volatile month, and we saw that play out with mixed performances across the board. Nvidia is on its way to the $200 mark. It was up over 5%, whilst on the other hand, we have Meta dropping nearly the same amount. Meanwhile, one sector that we continue to be pounding the table on, healthcare, finally showed signs of life, with several names jumping up double digit. But despite these wins, investors are still nervous. Many are asking whether or not this record-breaking run is on borrowed time. And the big concern, well, this comes from stretched valuations and massive amounts of AI spending, which could be unsustainable. We even have bullish voices like Tom Lee now calling for a single-digit return on the S&P by the end of the year, and that is why today's episode is incredibly important. We're going to look at 6 growth stocks, which, when we look right across the market, many companies in many industries are looking overvalued. That also applies when we look on a price to earnings growth basis. So the companies we're looking at are trading at attractive valuations, high growth potential, and the chance for massive upside ahead. Now, the first company we're looking at is Mercado Libre, the largest e-commerce and fintech platform in Latin America. Is often called the Amazon and PayPal of the region, operating an online marketplace, digital payments, Mercado Pago, and logistics and lending services across multiple countries. Now, it is up around 11% over the last year, year to date up 28%, but actually in the last 5 days, this company has dropped significantly, negative 14%, currently sitting around the midpoint of the 52-week range, and over the last 10 years, well, this one has massively outperformed the S&P, up more than 2,200%. On a pullback as well from its all-time highs, with Wall Street giving it a strong buy rating and a respectable buy rating from Seeking Alpha as well. Now, we have to point out the reason why this company did drop, and that is due to Amazon increasing their presence in Brazil, a region that Mercado Libre are in, and investors are concerned about competition. Is Amazon going to take away a lot of the customers, a lot of the clientele, and ultimately the revenue away from Meli? And something that Amazon Brazil are doing, which is obviously going to take away some of the customers from Meli, is they're making their marketplace free through the holiday season. And if we just take a look, this is in fact the worst 2-day period of Meli since November last year, and some analysts actually believe this maneuver, which looks to be very aggressive, is Amazon saying they're looking to come into the Brazil market head to head with Meli. And ultimately, we all know how big of a company Amazon is, and you may perhaps think that this drop is warranted. But if we look at both their commerce and fintech revenue, not only has it increased very strongly over the last 5 years, but both, in fact, we're talking about a compounded annual growth rate of over 50% on each income stream. And if we talk about their fintech part, well, that's also growing. Comparing that to NU Bank, we can see, yes, they do have a larger number of monthly active users, but Meli are growing it at a faster rate. We're talking 32% versus 22%. And their growth in the Mexico region has been very, very strong, 52% going as far back to 2012. In fact, we're seeing very rapid growth in just the last few years, so there is lots to love with this company. And in fact, they're expecting the next 4 quarters to show very strong double-digit growth to the earnings per share. Granted, though, they do have, over the last 4 quarters, a 50% track record, 2 out of 4 beats, missing the most recent one by more than $1. But if you do believe their estimations into the next full accounting period, well, the forward P will drop to around 32.7. And valuation is what we want to discuss. We did say at the beginning we're talking about attractive companies. Now, D- isn't great. Forward P just below 49, trading at a 169% premium to the sector overall. But if we look to their 5-year average, they're actually trading at a very significant discount. But what we want to highlight today is on a price to earnings growth, incorporating how fast this company is expected to accelerate, which we'll touch upon. 1.51 in our opinion is something to take serious note of. It's also low in the sector of 1.82, a 17% discount. anything below 2 is definitely one for consideration. And speaking of growth, they do get an A in fact. Last year they grew top line 36%, expected the same this year, and when we look at it against the sector, massive disparity, although we should point out they are growing slightly slower than they have done over the last 5 years, but actually trading at a much cheaper valuation. Earnings per share also looking very strong, expected 32% over the next 3 to 5 years, above the sector comparative at 10.6, but below their historical 46%. Is also one institutions like with 88% ownership, selling $14 billion worth of shares in just the last 12 months. They bought near enough $19 billion, and whilst we don't see too much movement in Q3, we noticed in the previous quarter with the full data set, institutions bought more than twice as much, so they have been recently net buyers. Now with each of these stocks, we are going to give you our own intrinsic valuation. Now we have $2,426 derived from the DCF model, but actually if we take a look, we've been extremely conservative using a growth rate of 2%, and before we even get into the makeup of this model, on a reverse DCF model, this highlights how much growth is baked in at the current market value. Well, not even 1%, 0.5. So that already tells you extreme undervaluation unless you believe it should be lower, in fact negative. And using 2% with a discount rate, we get the present value of future free cash flows and terminal price, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, getting to $2,426, upside of 12%. Now we've been incredibly conservative here. If you want to use the middle rate, which is typically what we use at 6%, we're talking over $3,200. That is 50% upside. And in fact, you could still argue 10% is very conservative, where we're talking near $4,400. That is a double from today's price. Now we'll show you at both the low and medium rate what margin of safety we're looking at, and that is something we always use. In fact, we typically kick off with 10% execute buy if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. Already incorporated today is a 10% margin of safety using, remember, a 2% growth rate moving forwards, but those that want to see a 20% MOS will a buy at 1941, at 25 a buy at 1819. Now in terms of Wall Street, very bullish. We saw strong buy rating, 36% upside into next year, their target price just below $3,000. Now let's move on to something that is a little bit more appropriate at 6%, and we're talking $3,268, a margin of safety of 34%. Definitely one for some serious consideration, and if you want a deeper dive into any of the companies today, do let us know below. So what do you think? Medi, Mercado Libre, a buy, hold, or avoid? Before we move on to the next stock, just to let you know, we have released our latest free weekly article. We drop one every single Sunday morning to your inbox, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of October. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab a copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're covering is the well-known Uber, the global mobility and delivery platform that connects riders with drivers and customers with food, grocery and freight delivery services, operating through different segments, up 32% in the last year, year to date up 60%, and it is trading towards the upper end of the 52-week range. Another strong buy, this time from Quant. Wall Street not far off the 4.5 for a strong buy rating, and Seeking Alpha coming in with a buy but slightly weaker. One thing we love with this company is whilst their top line revenue has been increasing quarter on quarter, they've actually managed to keep their total number of employees not growing anywhere near, and in fact in some quarters it has started to decrease, where we also see a very beautiful picture of their free cash flow. Yes, it has been negative for quite a number of quarters, but since turning positive we can see continuing to climb. That is exactly what we expect if management can continue to execute, and in their latest quarter, top line was up 18% year on year. We got some efficiencies from operating profit, 4 percentage points, and bottom line up 1. And we can also see here monthly active users up 15%, number of trips up 18 as well. So lots of great things to see from the company. And even though they expect the next 3 quarters to be a decrease to the EPS in comparison, when we look at the earnings per share in 2025, then into 2026, the forward P is estimated to lower to 27.3. And again, valuation C-, not the greatest in comparison to the sector where you're paying a 24% premium, but actually you're getting a 26% discount to their historical. Another one looking incredibly attractive on a price to earnings growth, 1.16. So far, these 2 companies are looking like one for serious consideration. And growth at an A, 18% top line last year, there or thereabouts, 17 this year, well above the sector. Another one though, like Melly, that is growing slower than their historicals. Earnings per share looking good, 23% over the next 3 to 5. Well above sector at 12. Now institutions, 80% ownership, selling $20 billion in the last year, buying around 50% more. They bought a lot more in Q3, the same in Q2 and Q1, so definitely something they're bullish on, at least in the shorter term. In fact, if you wanted to see a quarter where they sold more than they did buy, you'd have to go all the way back to Q3 2022. Definitely tells you what institutions think about the company. Now, intrinsic value at $146, again from the DCF model, really does come down to where you picture the growth rate moving forwards. Firstly, baked in 9.2%. If you believe 15% is appropriate, we're talking 52% upside. Even higher at 20, 116. So we'll show you at the medium and the low rate in terms of a margin of safety. But if you believe this medium rate is appropriate, 34% MOS. Wall Street themselves, $115 into next year, 20% upside. So let us know your views on Uber. And for those that do want to be more conservative at 10%, you are still getting a margin of safety, but to a lower degree at 6. Now at 10, it becomes a buy at $92, at 20, a buy at $82, and at 25, $76. So let us know your views on Uber today. We then move on to the next stock, which is SoFi, the US financial technology company offering loans, banking, investing, and insurance services, focusing on helping individuals manage personal finances as well as, in fact, building wealth. Now, an incredible run, up 222% in the last year, up 64% year to date, trading not far off 52-week high at just above $30. However, today, just one buy rating on the weaker side from Seeking Alpha. Now, this is one that is stealing away customers from the competition. If we just take a look at the number of deposits, some insane increases quarter on quarter. We can in fact see the deposits has been growing at a rate of 178% year on year. And their most recent quarter, we saw top line up 43%, massive efficiencies, 8 percentage points to their bottom line, as well as members and products both up, in fact, 34%. And if we look at their members on a trailing 12 month, well, we can see the growth just continues to move in the upwards trajectory. In fact, it's been growing at a CAGR since 2019 at 57% year on year. Now, out of the next 4 quarters, 3 of them they're expecting strong double-digit growth, 100% track record, and with earnings per share next full year at 55 cents, which in all honesty, I do believe they will smash through, something they continue to be doing. Then the forward P drops down to 45.5. Now, valuation, we do get a D-. If you want to look at a forward P, no surprises. In fact, they are trading at a massive premium, but the way they are, in fact, increasing a lot of their underlying metrics, there are no surprises, and we can see price to earnings growth coming in at 3. Ideally though, we'd want to see this around the 2 mark. And the growth also impressive, A+, 30% last year, 27% expected this year, well above the sector, similar trend as the previous companies, lower than their historicals, where in fact earnings per share projected to grow 27%, looking very strong indeed. Now, institutions hold 38% ownership, selling $1.3 billion, buying a lot more at 2.2. Also, we noticed a lot more in Q2. However, Q1 of this year, we did see the complete opposite. Now, our intrinsic value at $34, again, will depend on what growth rate you believe to be most appropriate. We have baked in 15.4%. If you believe the low and the medium are a little bit too low, a bit ridiculous, then the high at 20% does give rise to upside of 36. If you believe no, it should be lower, well at 15, we're talking not too dissimilar from the market price, hence why reverse is 15.4%, at 10%, downside of 32. But if you do believe 20% to be most appropriate, then around $34, indicating today a 25% margin of safety. Wall Street themselves see this at $25, in fact, into next year, hence no upside, and that is why we got the hold rating minutes ago. Now, an exercise we continue to look at when we talk about SoFi, for those that believe it will soon eclipse the market cap of PayPal, then that would take the company's price to $55, indicating upside of 120% as of today. Let us know, SoFi, buy, hold, or avoid. We then move on to Hims & Hers Health, the US-based telehealth company founded in 2017, is a digital platform connecting consumers with licensed healthcare providers for treatments spanning sexual health, hair loss, mental health, weight loss, and more, and they operate on a direct-to-consumer model, providing personalized care through online consultations as well as, in fact, prescriptions. Now, the company's up 207% over the last year, however, they dropped nearly 10% just at the end of close Friday. Year to date, they are up 117%, and they're trading a little bit away from 52-week high at $73. And yes, a hold from Wall Street and Quant, but a fairly respectable buy rating from Seeking Alpha, where their revenue since the end of 2019 has been growing at a CAGR of 75%, and they anticipate strong growth from 3 of the next 4 quarters, 100% historical track record, and if they do hit EPS target 2026, forward P 65. Now, growth does come in at a D-, but if you want to take a look at a price to earnings growth, although this is on a trailing 12 month, well, 0.08, sector sits 0.65, just telling you this could be another great opportunity. And growth grade A+, 89% year on year, 47 this year, well above the sector, but again, we're getting a similar trend. It isn't higher than what they have done over the last 5 years, with earnings per share projected just below 20%, a lot better than the sector at 10. And institutions, 64% ownership, selling $1 billion, bought around 50% more. They also bought a lot more in Q2, little bit in Q1, but we can see they are in fact a little bit inconsistent. Some quarters more buying, others more selling. Now, our valuation at $58 is derived using a growth rate of 20%, baked in today 18.7. If you believe this to be appropriate, well, upside of 9, higher upside of 53, lower downside of 23. Now, based on this $58, we see an MOS of 8.5%. If you wanted 20%, well, a buy at 46, and 25 around 43. Wall Street themselves don't see upside into next year. In fact, they see this $52, downside of 2. But let us know your views on Hims & Hers Health, and if you believe we're being too conservative, we're at 25%, $81, indicating 35% margin of safety. Let us know, Hims & Hers Health, a buy, hold, or avoid. We then move on to Grab, which is a Singapore-based tech company operating a soup app that provides ride-hailing, food, and in fact grocery delivery, as well as digital financial services across Southeast Asia, and this was founded in 2012, expanding to countries including Singapore, Malaysia, Indonesia, and the Philippines. Now, they're up 66% in the last year, 31% year to date, trading near 52-week high at just below $7. A buy from Seek Alpha, very near to a strong buy from Wall Street at 4.48, where they're expecting mammoth growth over the next 4 quarters. In fact, EPS, if they hit into next year, forward P will come down to $54, and their valuation coming in at a D-, really highlighting how much higher they're valued than the sector, 467%, and their growth comes in at an A, pretty consistent. Last year top line 19%, expected there or thereabouts at 20 this year, above the sector in the mid-single digit, and institutions holding 55% ownership, selling $2 billion in the last year, bought a lot more at $7 billion, bought more in Q2 and in Q1, huge buy in Q4, really highlighting institutions are loving Grab stock. And it's not just then, if we look at super investors, well, in fact, we have the famous super investor Howard Marks adding to his position in the most recent quarter. And if we take a look at his portfolio composition, it does make around 1.5%. May not look like a lot, but the majority of his stocks are in fact sitting around the low single digit. Now, intrinsic value at just below $8 is derived using the lower growth rate at 10%. Baked in is 6.1. We're talking more than double if you believe this to be 20%, 69 at 15, and at the lower rate, 25%. So using that 10% in fact today, and as always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for grab or any others, gives rise to a 20% MOS. If you wanted 25, well, buy at $5.80. And in fact, Wall Street themselves believe $6.50 will be the price into next year, only 6% upside. If you believe we should use 15%, well, you can in fact note 41% margin of safety. So let us know about Grab stock overall. We then move on to ServiceNow, the US-based cloud computing company specializing in enterprise software that automates digital workflows for businesses, and its platform helps organizations manage IT services, employee workflows, customer service, and security operations, which ultimately aims to improve efficiency and reduce manual processes. Now, the company is up 2% in the last year, year to date down 14, over the last 10, massive outperformance of the S&P, trading around the mid to lower end of the 52-week range, a strong buy rating from Wall Street, where they've increased their revenue over the last 10 years at a compounded growth rate of 30%, and they also expect double-digit growth over the next 4 to EPS, 100% track record, forward P lowering to 46 into 2026, and yes, valuation at a D- on a forward P, 111% premium to the sector, 25% discount though to their historicals, and on a price to earnings growth, another super attractive 1.6, 12% discount to the sector, 28% discount to their 5-year. Growth looking good at a B+, 21% revenue top line last year, 21 expected again this year, above the sector on both accounts, not too dissimilar from their 5-year average, although a little bit lower. Earnings per share looking solid, 34% projection, above the sector at 15, and a little bit in fact above their historical. Now, institutions, 87% ownership, selling $19 billion, bought more than twice as much in the same time frame, bought more in Q3. In fact, the reverse of the trend, you would have to go to Q1 2023. Obvious, ServiceNow an institutional favorite. In our intrinsic value at $1,091, in fact, we can see is using a growth rate of 20%. Baked in 17.3, so if you do use the lower growth rate, it will be 15%, where we notice downside. So using the middle rate at 20%, we note a 16% margin of safety. If you wanted 20%, we'll abide 873, at 25, 818. Wall Street themselves, well, they note $1,185 into next year, 30% upside, but give us your views today on ServiceNow. Is this one to seriously consider, as well as the previous 5, whether you point them out as a buy, hold, or avoid? Don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon, where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.